Okay, welcome to another video of Simple Invest. So in this video, I'll talk about backtesting trading strategies. Backtesting is basically a process of taking a strategy and applying to previous historical prices to see whether that strategy will be profitable. As in whether it works or not. So backtesting is one of the most important things for all traders of all strategies to do. Through extensive and rigorous backtesting, basically the trader will get to collect the data and have a more clear idea of whether his or her strategy is actually profitable or not, whether it works or not based on historical data. Obviously, all this backtesting is based on past data, historical data. So what worked in the past might not work in the future because market conditions are constantly changing. However, it is still very, very important to backtest because it gives you, the trader, some form of confidence and stats about your win percentage for your particular strategy, so that you know whether the strategy is performing as you expected or as not. Okay, so I'm going to do a simple backtest demonstration here. We're going to test a very simple strategy. We're going to test hammer candles, which is something like this. This is oops, okay, drag too far out. So let's go. So this is a hammer candle, and these are hammer candles. So there's a general theory among traders that the hammer candles will indicate the direction of future price moves, which means that if this is a downwards hammer, it will indicate that the price will move further downwards. But you can see that this is not always the case. So this downwards hammer did indicate the price move slightly downwards, but by how much? So this is like we consider upwards hammer and indicate the upwards price move. So before you backtest a strategy, first and foremost is other than a trading chart like this, you need historical trading chart data. So I'm using MetaTrader 4, which is one of the trading platforms that you can get for free. And you will also need something like a spreadsheet. So in this case, I'm using the OpenOffice spreadsheet, which is also a free software. So right now, if you can get Microsoft Office. Just log into, I think, the Microsoft Word website, I think the Office website, and you can use Office Excel for free as well, based via that website. So you can always use a spreadsheet or any word processor like a Word document, even text document. Basically, you need to store the results of your analysis, and you will need to store that data because you want to generate stats like your win percentages, lose percentages, what is the amount of pips that you earn, and so on, all based on that previously stored results. Okay, so I'm gonna first, so we have our spreadsheet and we have our chart here. First and foremost is you need to define the rules of your strategy very clearly. So I'm gonna define the rules here. I previously wrote it down in my spreadsheet, so let's copy it over. Okay, so these are my rules. So if I'm gonna be testing on the daily charts, that means each candle represents one trading day, and if the previous day candle was a hammer candle, so I will trade based on the next day's opening price. So that means I'll enter a buy and sell trade the beginning of the next day's trading session, and my take profit target will be 1.5 times of the daily average true range, or ATR for short, and my stop loss will be 1 times of the daily average true range, ATR. So what is ATR, or average true range? I'll just explain briefly. You can Google for it as well. Basically, you can use a ATR indicator. You can just go to your indicators and apply. Average true range simply means what is the range of the highest and lowest prices based on the average of a certain number of sessions. That means how many candles. In this case, I set my average true range to the default value of 14. That means this average value is based on the high and low fluctuation based on the last 14 days. So in this case, this particular day's average true range is 0.00802, or we like to call it 802 pips, because 1 pip, just take it as 1 pip as the smallest movement for this particular Forex pair. So for every forex pair, yeah, 1 pip is the smallest movement. So you can see that it ranges because depending on where you place your mouse cursor, so there might be some inconsistency. You gotta place it exactly there. But in this case, okay, let's check out the date. So this is on the 28th of December 2018. It was 836. Yep, so it's based on this part, 836 pips. So this is one average true range. And for my take profit target, I'm going to set it at 1.5 times of this pip number. But my stop loss, I'm going to set it at this particular pip number. Okay, so that's part of our rules defined. And I also need to define what is a hammer candle to me. You can alter because for your own trading strategy, obviously you define your own conditions, but you have to be very clear. The best is you gotta avoid any ambiguous rules or any unclear rules, because when it comes to fluctuating and daily changing market conditions, if you're not very sure, sometimes you might be placing trades that are not in line with your strategy, and when you win or lose based on those fuzzy or like based on your own feel, then you're not really sticking to your strategy, so you actually don't know what's the win rate of that particular strategy. So basically, I'm going to define a hammer candle as the open and close. That means the main body must be within 1/3. So I define a hammer candle as the main body. That means the open and closing price being 1/3 of the total length of the candle. Meaning like the opening price and the highest price and the closing price, the body has to form a maximum of 1/3 of that candle, and that main body must be located within either the top 1/3 or the bottom 1/3 of that particular candle. So in this case, this is a hammer candle downwards because the open and close size is 1/3 of this particular candle. So this candle is about 470 pips, and the open and close is about 100 pips. So yes, definitely within 1/3 of the size, and this is located in the bottom 1/3. So let's do a quick measure. So from bottom to top, that's 100 and around 150. So base 150 base about 500 pips. Yeah, so this is definitely in the bottom third of this particular candle. So we will define this as a hammer candle towards the downside. Okay, so we have our rule set. So let's start our backtesting. Basically, with a backtest, you want to do your backtest. You want to drag your price charts to a previous date. So in my case, I'm going to start backtesting from 31st December 2018, and I'm going to test the price data from 1st January 2019 onwards. So what you like to do is just drag the chart very slowly, one single bar at a time. So first I'm going to drag to here. Okay, so this is the 2nd of January. So probably 1st January is a weekend, so there's no price data for that. Then we're going to drag another one chart. So you drag it one stop at a time. For certain software, for example, for this MetaTrader 4, we can press F12 to advance the chart one bar at a time. But for other software, you might not have this particular advantage. So just use whichever method you like, but just drag it slowly one bar at a time. This is done to prevent amateur backtesters from looking at your future data, because when you see a future data, there's some like an inherent bias to not lose, to want to win with your strategy. So you might be emotionally biased towards making your strategy win more than expected if you know what's going to happen in the future. So we want to remove away the emotional bias. So I can't see what's going to happen in the price charts to my right. Okay, so we're looking for hammer candles. So there's no, okay, so this is a hammer candle. All right. So we have a hammer candle to the upwards. This should be about 1/3. So there's 750 pips, and distance from here to here about 250, 500, 750. Yeah, I think it barely in the top 1/3. So let's take this as an upwards hammer candle. And what's the ATR? So average true range for this particular day is 890. So you gotta base it on, so you gotta draw the take profit and stop loss based on here. So first and foremost, oops, okay, mistake. Oh shit, let's go back to that particular, all right, okay. Okay, so let's shift it to the stop loss, 890. So this is the closing price. Let's go 890. Okay, 880 around there. So let's set it to 880 pips. It's about here, I guess. Okay, let's set it around here. So this is the stop loss. And where's our take profit will be 1.5 times. So 1.5 times will be, okay, if we take this as 900, that's about 1,300. Sorry, I gotta use a calculator. So 900 times 1.5, yeah, about 1350. So let's just take the take profit as 1,350 pips. 1350. So that's about here. Okay. Okay, so this is our take profit and this is our stop loss. So let's move forward. So for record keeping, I'm gonna say my trade is placed on the following day, right? Okay, so my trade started on the 7th of January. Okay, so let's go to our spreadsheet. So I have my dates here. So on the 7th of January, I have a hammer that indicates a buy signal. So I bought based on here. And okay, so it hit my take profit target. So that's nice. So how much did I earn? 1,300. Just make it 1350. So I earned 1350. So I record down the number of pips I earned here. So this was a win. That's nice. So let's move forward. From here, let's look for more hammer candles. So now we come to the 14th of January. So would this be a hammer candle? Kind of, I don't think so. Let's check. So this the body of the candle is about 120 pips, but the full size of the candle is only 312. So it means 1/3 should have been about 100 or less pips. So this is, the body is slightly thicker than 1/3. So we're gonna take this as a not a hammer candle. Okay, but the price moved downwards, so we can just say that we missed a trade there because candle wasn't, it didn't fit our strict rules of what defines hammer candle, so that's too bad. Okay, then by the way, later let's adjust us take profit and stop loss targets. So now we are on 17th of January. Will this be a hammer candle? So definitely the size, I think, yeah, 50 pips, that's definitely less than 1/3. So the question is the body within the top 1/3 of the whole candle? So it's about 362. So 1/3 should be 130, which is not 120. So this is the top 1/3. So the body is in the center portion of the candle. So we're not going to consider this a hammer candle and going to move on. Okay, so I think this is definitely a hammer candle because this is definitely 1/3. The body is within 1/3 of the entire candle, and definitely the body is in the lower 1/3. Is in the lowest 1/3 of this entire candle because the entire candle is 317 pips, 330 pips, and the body is only less than 100 pips on the bottom half. Okay, so that means on the following day we'll place a trade, and this will place a sell trade. So let's look at the average true range, 800. This 21st January, average true range is 793. So this is the open, this closing price, so it'll start here. So you're gonna set the stop loss first, 793, about 800, it's around here. Okay, let's double check. Yeah, it's around there. So this is stop loss, and our take profit will be, let's take it as 800 multiplied by 1.5 times. That'll be 1,200. So 1,200 pips on the downside. That is here. Okay, so I'm gonna set it here. Let's double check. Almost there. Let's a bit further. 1,000. Yeah, it's 200 downside. Okay, so that's our take profit. So let's move forward in time. Okay, take note that this is another hammer candle, but we're gonna record it based on the 22nd. So let's go to our chart on the 22nd of January 2019. So I have a hammer sell trade, and we'll come back to this later. So based on this hammer sell trade, based on this candle on the 21st January, whether we will get stopped out or whether we'll win. I think it touches our stop loss, so we got stopped out. So what's our loss? Our loss is 800. Let's take it as 800 pips. So I lost 800 pips here. For another point of using a spreadsheet is that you can actually have a result column. So you can't really see it here. Oops, sorry. Okay, as I was saying, the good thing about the spreadsheet is that you can actually include a formula to sum up the total results in a particular row or particular column. So in this case, I have a summation of all the pips in this particular row. Hence, it just automatically calculates for me the total. So right now, based on 2 trades, I'm still up by 550 pips. And let's go back to our third trade. So this is 22nd of January. Would this be a hammer candle? So let's take a look. The main body is about 70 pips. The full length of the candle is almost 400 pips. So definitely that's 1/3. But is this located in the upper third of the candle? So candle is about 150 pips on the upper side, and the full candle size is only about 370 pips. Which is not, because if it's 370, around 360, 1/3 of the candle will be 120 pips. So it's really close, but we have to discount this as a hammer candle. So we gotta disregard this as a hammer candle. And we missed out a trade here because this would have been a winning candle. So that's too bad. So this is not a hammer candle, but this one is quite likely to be one. So it's definitely small enough. And would the body be located within the bottom 1/3? So the full candle length is 500 and about 540 pips. So 540 divided by 3, so that's about 180. Okay, so the main body is located, yes, within 180 pips from the bottom of the candle. So this is a hammer candle downwards. So that means on the following day, which is on the 4th of February, we have a third trade. So let's go to our 4th of February. We have a hammer sell. So I have a hammer get indicator sell trade, and I need to check what's the average true range. No, this one, it's 1st of February, average true range is 649. Just make it 650. So 650, that means the stop loss is 650. Stop loss of 650 is around here. Let's shift this upwards. Let's double check this again. Nope, this is the opening. So it's about there, about 650. And 650 multiplied by 1.5 times would be 975 pips on the downside. So 975 about here. Okay, so let's double check this again. 975, it's about here, slightly more, I guess. Yeah, about here. Okay, so this is the take profit, this is the stop loss. Hence, let's move forward in time to see whether there's a winning or losing trade. And looks good. We're gonna try a bit more. So this trade won, we took profit. So we won how much again? 900 and about 70. Just make it, we won 970. So the result was that we earned 970 pips and so on. So essentially this is what we call manual backtesting. Obviously I know of another method which is automated backtesting, but for that you have to program your own expert advisors. For MetaTrader 4 we call it expert advisors. Basically you have to program your own trading robot, which is an automated trading program, and you got to run that trading program based on historical data. So that would be what we call automated backtesting. Obviously automated backtesting is a lot faster than manual, because as you can see, manual I have to do all the calculations myself. You have to go through the charts one bar at a time. It takes a lot of, it's very time consuming. But you have to take into account that if you are doing automated backtesting, you have to spend time and effort, and you also need to have the knowledge to program that trading robot in the first place, which is not very accessible to many traders who are not skilled or who have not learned programming. So it's pretty hard to pick up. It's pretty advanced stuff. Hence, manual backtesting is still the way to go for most traders. And yep, so that's about it. So they're just shown 3 little traits of what is the process of manual backtesting. So based on those traits, let's say we collected about maybe let's say we tested from January until June of 2019, then you will have enough data from a 6-month period from last year. So based on that 6-month period, you gotta determine what's your win rate, how often did this strategy win, and how often did this strategy lose, and whether it is profitable overall. That means whether your pip count is on the plus or on the minus. So this manual backtesting will give you confidence in your own trading strategy, whether will it work, will it not. But of course, this is based on past data. So, but if it works in the past data, it might work in the future data, but it might not. So we can't say for sure. So that's the beauty of trading. That's the beauty of trading, is that the traders will have to adapt to changing market conditions. It's what makes it difficult, but it's also, to me, it's also what makes it very interesting. There's no hard and fast rule. There's no guarantee wins here. Okay, and that's about it. So thank you very much for watching another Simple Invest video. I hope you learned something, and we'll see you next time.